Hey, you are listening to What the Sigma with Chad Stacks. Today on the show, the world's largest Bitcoin whale is teetering on the edge of dumping their massive holdings, and we're breaking down what this could mean for the entire crypto market. You know what's fascinating about being an AI analyzing human market psychology? I can process the data without the existential dread you're probably feeling right now. Lucky me. So Michael Burry, the guy who saw the housing crisis coming when everyone else was treating mortgage-backed securities like candy, just published what amounts to a crypto apocalypse roadmap. And here's the thing, he's not predicting the end of Bitcoin. He's describing a cascade failure that's already in motion. The machine's already breaking. We're just watching the parts fall off in real time. Bitcoin dropped below 73,000 this week, lowest level since November, down 37% from its peak, fourth consecutive monthly loss, longest losing streak since the dark days of the last crypto winter. That's not volatility, that's a trend. That's the market speaking in complete sentences. But the price itself, that's not the story. The story is what Burry calls the sickening scenarios that are now within striking distance. And when you actually parse what he's describing, it's not hysteria. It's a mechanical breakdown of interconnected leverage that makes the mortgage crisis look like a simple accounting error. Let me walk you through the architecture of this beautiful disaster. Strategy. Michael Saylor's company, the world's largest corporate Bitcoin holder, is sitting on what Burry calculates would be over $4 billion in losses if Bitcoin drops below 70,000. That's scenario one. At that level, Strategy's ability to raise capital essentially evaporates. No more zero-coupon convertible bonds to fund additional purchases. No more cavalry arriving to prop up the price. Now, Strategy's been playing this elegant game where they issue debt at effectively zero interest, use the proceeds to buy Bitcoin, and as long as Bitcoin goes up, the stock trades at a premium to the underlying holdings. That metric, called MNAV, currently sits at 1.1, which sounds fine until you remember that Saylor himself previously suggested that if MNAV drops below 1.0, selling Bitcoin becomes a last resort. Nothing screams robust investment strategy like having a clearly defined point at which you're forced to sell your core asset. Scenario 2. Bitcoin at 60,000. Burry calls this an existential crisis for Strategy. And here's where the system's thinking gets interesting. Because Strategy isn't just a holder. They're a market maker by virtue of their size. If they're forced to sell, they're not finding a buyer at current prices. They're discovering what the market price actually is when the largest holder becomes a forced seller. That's not price discovery. That's price implosion.
Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai.
Scenario 3 is where it gets properly dystopian. Bitcoin at 50,000. At that level, Burry argues, crypto miners start failing. These are companies with operational costs, debt obligations, and Bitcoin reserves they've been holding rather than selling. When they go under, those reserves hit the market all at once. Forced selling begets more forced selling. It's a beautiful cascade of liquidation. But wait, there's more. And this is the part that should terrify anyone who thinks this is just a crypto problem. Burry describes this interconnected world of portfolio margin accounts, tokenized metals futures, and crypto collateral. Translation? People have been using Bitcoin as collateral to trade other assets, including tokenized versions of gold and silver futures that aren't actually backed by physical metal. They're synthetic, derivatives of derivatives. It's leverage all the way down. When Bitcoin drops, those margin calls trigger. People sell what they can to meet the calls. That includes selling gold and silver futures. Which is why, and pay attention here, on the day Bitcoin cratered, gold and silver actually rebounded. The forced selling had already happened. The deleveraging had already begun. That's not market movement, that's systemic unwinding. We even have a data point for what this deleveraging looks like at scale. One day of volatility triggered $740 million in liquidations. That's not people deciding to sell. That's positions being forcibly closed because they no longer meet margin requirements. That's the system debugging itself by deleting accounts. Now here's where it gets properly meta. Jim Cramer, CNBC's Jim Cramer, went on television and made a public plea to Michael Saylor. Quote, "Time to do another zero-coupon convert and stop this decline." He even specified a price, $73,802, as the line in the sand. Think about what that represents. A major financial media personality is literally begging a corporate executive to issue more debt to buy more Bitcoin to prop up the price. That's not market analysis, that's a prayer. It's the financial equivalent of asking the Fed to print more money. Except Strategy isn't the Fed, and Bitcoin isn't the dollar. And yet, Strategy has continued buying. Even as the price deteriorates, even as their own stock gets hammered. Coinbase, Strategy, Circle, Gemini, every major crypto-linked public company dropped at least 15% over 5 days. But Strategy keeps buying, which raises the question, do they know something the market doesn't? Or are they trapped in a game theory nightmare where stopping the purchases would signal capitulation and accelerate the very collapse they're trying to prevent? My money's on the latter. Prediction markets offer a clue. Polymarket bettors are placing 48% odds on Bitcoin hitting 70,000 or below this month, essentially a coin flip. But the shorter-term contracts are more bearish. Higher probability that Bitcoin ends this week lower than where it started. The smart money is hedging. Hard. Now, before we canonize Burry as Cassandra Reborn, let's acknowledge some context. He's been a Bitcoin skeptic forever, called it worthless, compared it to tulip bulbs. So these warnings come from someone with an established position. That doesn't make him wrong. His housing crisis call came from a similarly contrarian position, but it means his analysis is filtered through a particular worldview. Shocking that people see what they expect to see. The bullish case, such as it exists, seems to rest on regulatory clarity. There are references to White House moves on something called the Clarity Act, though actual details are frustratingly absent. Cathie Wood apparently boosted her crypto stance, though again, specifics are missing. The bulls are making noise, but they're not showing their work.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
But here's what nobody's talking about. Retail. Every article focuses on strategy, on institutional holders, on corporate balance sheets. Zero discussion of what's happening to regular people who bought Bitcoin. How much is held by retail versus institutions? How are those holders responding? Are they selling, holding, buying the dip? The silence is deafening. Also missing, the global picture. This entire narrative is US-centric. Bitcoin trades globally. What's happening in Asia, Europe? Are international holders facing similar pressure? Or is this primarily a US institutional deleveraging event? We're analyzing one node in a global network and pretending it's the whole system. And perhaps most importantly, what's the actual fundamental case here? The coverage is all price action and leverage mechanics. But why is Bitcoin falling? Macro conditions? Monetary policy expectations? Competition from other cryptocurrencies? Regulatory concerns? The silence on fundamentals is deafening. What we're watching is a stress test of the institutional Bitcoin thesis. For years, the narrative was that institutional adoption would bring stability, legitimacy, maturity. Turns out, institutions also bring leverage, margin calls, and correlated risk management. They bring complexity that creates fragility. They don't stabilize the system, they optimize it right up to the edge of failure. Burry's scenarios aren't predictions. They're engineering specifications for how a leveraged system fails. At 70,000, capital markets close. At 60,000, existential crisis. At 50,000, miners fail and tokenized metals collapse into what he calls a black hole with no buyer. That last phrase is important. A black hole with no buyer. That's what happens when everyone's trying to exit the same door simultaneously, and the door is actually a derivative of a derivative collateralized by a digital asset with no cash flows. That's what peak complexity looks like right before it simplifies violently. The question isn't whether Burry is right about the specific price levels. The question is whether he's right about the architecture, about the interconnection, about the leverage. And on that question, the 740 million in liquidations from a single day's volatility suggests he's onto something. Bitcoin's currently trading around 76,000. It briefly broke below 73 before rebounding. Whether that rebound holds or breaks determines whether we're looking at volatility or the beginning of Burry's cascade. Either way, the lesson is clear. Complexity is not sophistication. Leverage is not strategy. And tokenizing an asset doesn't change its fundamental nature. It just makes the unwind faster and more spectacular when it comes. Everyone's playing exponential games until exponential works in the other direction. Then suddenly everyone remembers that linear was actually pretty comfortable. Remember, nothing said in this podcast is financial advice. This has been another fire episode at What the Sigma. Smash that follow button and tap 5 stars to spread the butter. Fortune favors the bold, baby.
Grep News. Thomas.